All right, folks, today we got one of the biggest data releases in housing for the month, and it's existing home sales. It comes from the National Association of Realtors, and the numbers came in much, much hotter than expected. And that's a big deal because remember, mortgage rates, they're still elevated. Affordability is still a challenge, and consumer confidence has definitely been shaky. But buyers of real estate are still stepping in to this market, and it's a really, really good sign. Now, is the market improving? Are buyers adapting? Well, let's take a look. Existing home sales in May rose 3.2% month over month. Now, the annualized sales pace was 4.17 million units in pending home sales. The economists were thinking closer to 4.07 million, so that's higher than expected. And this was the strongest sales pace since December of 2025. The median existing home price now sits at $429,300, and that is up 1.3% year over year. So there you go. Home values nationally are higher, and inventory is rising. We're now up to 1.55 million homes. Well, we rose to 1.55 million homes. So we're sitting at about a 4.5 month supply. So pretty healthy. All right. This one I love. Listen to this. First-time home buyers. First-time home buyers accounted for 35% of all purchases. That is the highest share for first-time home buyers since mid-2020. What a great sign that first-time home buyers are coming back into the market. All right, now all these references came from Reuters, Associated Press, and the National Association of Realtors release itself. We combed through all of that, gathered all this data just for you. Now, why is this important? Well, the report's important because last I checked, 30-year mortgage rates are still in the mid 6% range. Financing costs are still much higher than 2021. And we thought buyers have been sidelined for the last several years, but transactions are improving. The buyers are coming back, and the market is finally adapting for higher rates. And it's stabilizing. It really is. It looks like it is essentially stabilizing, even normalizing. And it looks like housing does not need 3% mortgage rates to function anymore. Buyers and sellers are getting some confidence and some certainty as rates stay in that range. Now, another big story here is that inventory keeps getting better too. And we're seeing more listings, we're seeing more options, and this is great because more inventory will help transactions improve. Now, that may seem obvious, but you do need buyers to step in. But buyers are finally thinking, hey, I'm shopping again. I got options, I got choices. And it's making the market appear healthier. Even while price growth is slowing, that's okay because buyers like that. They can see they have options and they're not chasing anymore. They're not chasing prices anymore. They can take their time, they can choose, and it feels a lot better, a lot healthier than it used to be. All right, now remember, existing home sales are closed sales, meaning many of these homes, many of these homes likely went under contract in March and April. Now, mortgage rates were a little bit eased during that period, so this data does reflect a little bit of that, maybe low 6% range for the 30-year fixed, so a little bit better affordability from earlier in the spring. And so there was some rate relief there. So that's important nuance, because rates did go back higher again in May. And we got to see what that will look like when rates ballooned up to about 6.6 to 6.7% on the 30-year fixed when we had that spike in oil due to the conflict in the Middle East between Iran and the U.S. So there's still volatility underneath the surface, remember, okay? But this is still overall good news, and it tells you without that volatility, we can have a pretty normal market. And that's my biggest takeaway for sure. Now, all right. If inflation continues to cool, okay, And I'm not suggesting that it necessarily will. I think we're going to still see pretty hot inflation data, especially since, I mean, it almost looks like that war is restarting. As I think there was some news here today on a U.S. helicopter that was shot down, and so, I mean, it's not surprising that tensions are well, they're not easing anymore, right? So this is a geopolitical situation, right? So we'll have to monitor it closely, okay? But if we ever get out of it and we just sort of allow inflation to ease again, which I think it will once we do get out of that situation, and I want you to imagine for a second what it'll be like if rates fall further. I mean, if it looks this healthy now, right? If buyers are already stepping in with rates in the mid sixes, what happens if rates move into the lower sixes or even the high fives eventually, right? That would probably mean significantly more transaction volume, more sideline buyers coming into the market, more move up buyers, more buyers who want to move. They finally say, I'm going to list my house, I'm going to move. That's okay. I can go from, 4% to 5.5%. I don't mind, right? Stronger confidence. And even investors stepping back in, reevaluating opportunities with lower rates. It could be a really big deal for the housing market. All right. Now, again, we're talking about normalization here. The market doesn't have to feel as constrained by those financing costs and the lack of demand if rates just come down a little bit more. Now, Lawrence Yoon, he made some important points here in the report, chief economist for the National Association of Realtors. He said, affordability has improved somewhat relative to last year because wage growth has continued. So that's a good point here, right? There's that X factor where incomes are rising, and that helps affordability too. Just doesn't have to be just prices come down. It doesn't have to be just that rates go lower. People can make more money, right? So affordability, right? Higher incomes, that helps. That helps. And I think that's one of the reasons why we're seeing more movement here. All right. Now, I want to just say, today's report doesn't mean housing is booming, doesn't mean affordability problems are solved, or rates no longer matter. Not suggesting any of that, but it does suggest that buyers are adapting to this environment and that more inventory is helping the situation. And the market may be slowly normalizing right before our very eyes. And if rates continue easing over time the way I believe they ultimately will, the housing market could look very different just 8 to 12 months from now. Try to picture it. It could look really, really good where we get a lot more transactions. And boy, are we due for more transactions in this housing market. Today's data showed something to me very important. Demand is still there. Buyers want to buy. And it may just be a matter of better financing conditions, lower rates, to really push the envelope and create that transactional volume that we're so used to seeing just maybe 6, 8, 9, 10, 11, 12 years ago.